The Psychology of Wealth in Crypto, a masterclass. I lost $2 million in crypto last year. It wasn't because of a bad token. It wasn't because of a thesis that broke. It was a position that did everything right, but I round tripped the entire thing. Life-changing money, gone. The chart didn't beat me. The market didn't beat me. The macro didn't beat me. I beat myself. I was in a meme coin community. I was a whale. I had taken size most people would never have dreamed of. And as that position went vertical, I had rules. I always have rules. Profit taking levels, pre-written triggers for invalidations, allocation thresholds. I broke every single one of them. Why? Because I cared what the community thought of me. Because trimming felt like betrayal. Because belonging felt better than discipline. The chimp inside me wanted to feel belonging more than the human inside me wanted to win. And the chimp won. The truth is, most investors and traders don't have a market problem. They have a chimp problem. And until you know what that means, you will continue to lose money to the market. No amount of research, no amount of analysis, no amount of conviction will save you from yourself. I learned that the hard way. You don't have to. This is the psychology of wealth in crypto. By the end of this masterclass, you're going to understand exactly who's making the decisions when you click buy and sell. You're going to recognize the 6 specific moments that sabotage your success. And you're going to learn the 5-step operating system top investors used to master their mind. No charts, no indicators, no technical analysis. This is the inner game and the foundation of every other masterclass in this series. Let's get into it. The real reason you're losing money. I want you to think about something honestly. How many times in the last 12 months have you bought something because it was running and you didn't want to miss out? How many times have you sold at a loss because you couldn't continue to watch your position bleed? How many times have you opened a position that you didn't completely understand because someone you respected posted about it? How many times have you held a bag past the point the thesis broke because you didn't want to admit you were wrong? How many times have you sat down at your screen and made a decision with no plan because you were bored? If your answer to any of those is more than 0, you're not losing money to the market. You're losing money to your mind. The normal guy is long at cycle tops and capitulates at the bottom. That's not bad luck. That's a wealth transfer mechanism engineered to work exactly the way it does. The market doesn't transfer wealth from smart to dumb. It transfers wealth from emotional to disciplined. Before we go further, write down the last 3 losses you took. Next to each one, write the specific reason you think caused the loss. Let's see how well you know yourself. The chimp, the human, the computer. In 2016, around the time I got into crypto, I read a book that changed the way I think about almost every decision I make in my life. It's called The Chimp Paradox by Professor Steve Peters. Steve is a psychiatrist who works with the British Olympic cycling team and elite athletes across the entire world. People whose careers depend on making the right decision under intense pressure. The Olympics come around once every 4 years. You don't get second chances. You could be the best in the world, and a bad 30 seconds leads to 4 years down the drain. Dream shatters, hearts broken. Steve's model is the clearest framework I've ever come across, understanding the way your mind works. My goal today is to translate Steve's model to crypto investing and trading. Let's get into it. In a single sentence, you don't have one brain, you have 3. The first one is the chimp. The chimp is your emotional brain. Fast, powerful, designed with one goal in mind: to keep you alive. It doesn't care about your portfolio. It cares about your safety, your status, and it feels first and thinks later. Your chimp is supposed to be there. You need it. It's what makes you feel excitement when something works, or fear when there's danger around. It's what gives you instinct. The biggest issue I see is people looking at their emotional mind and their chimp as a negative. They try to make it the enemy. That's wrong. The number of people I see trying to become a robot, hustle culture junkies, monk mode monkeys, it cracks me up. I understand it and I feel for it. We've all been there. But I've been in this game for a long time. And trust me when I say it doesn't work. The problem isn't having a chimp. We all do. It's allowing the chimp to make your decisions. Your chimp is the one buying green candles. It's the one panic selling red candles. It's the one revenge trading after a loss, or feeling FOMO and aping in when a friend shares a 5x. Every emotional, impulsive, reactive financial decision you've ever made has likely come from your chimp. The second operator is your human. Your human is your rational mind. You watching this video right now, the one who does research, builds theses, thinks in probabilities and time zones. But here's the catch. When the market's calm, your human is in charge. When the market gets volatile, your chimp comes out to play and starts to hijack your decisions. That's why your best decisions happen at 2 p.m. at your desk, on your desktop, with some caffeine on standby, and you can think rationally. And why your worst decisions happen at 2 a.m. on a Friday evening when you're already wiped out because you didn't sleep properly the night before, with Twitter open. The third operator, and the most important of all, is your computer. The reality is you can't reason with your chimp. It's too emotional, it's too powerful, and it doesn't speak a rational language. You can't rely on your human to keep your chimp in control, because your human gets overruled the moment things get too difficult. But the computer is so fast, it executes what you pre-install before your chimp can move. Think of your computer like your rulebook, your take profit ladders, your position sizes, your I never trade the same day I take a loss. Here's the model in one sentence. The chimp reacts, the human reasons, the computer regulates. The entire game of becoming a disciplined investor or trader is installing the right programs so that your chimp has fewer decisions to hijack. Don't be a master of your emotions. Be a manager of them. Open your notes app right now, write 3 columns, chimp, human, computer, and list all the decisions you made this week that you believe falls under each of those categories. Now, it's very unlikely your chimp has a longest column. However, it's very likely that the most consequential decisions you made that week, especially the negative ones with the largest outcomes, came from your chimp. Okay, these 6 hijacks. There are 6 specific moments your chimp hijacks control, and we're gonna go through every single one of them. I've experienced every single one of these over the years, and so has every top investor I know. The difference between the amateurs and the professionals is that the professionals recognize these moments and act accordingly. Let's get into it. Hijack 1, FOMO at the tops. Asset up 40% in a week. You see it on your timeline, you see it in your group chats, friend shares a screenshot of a big win, and suddenly the thesis that had no weight a week ago is the most obvious trade in the world. It didn't interest you at half price, but now it's a no-brainer. You buy, 72 hours later, it tops. Next week, you're down 30%. This isn't bad luck. This is a documented psychological mechanism as old as time. There's a book called Influence by Robert Cialdini. It's one of the most important books ever written on human psychology, and it teaches us how our brain actually makes decisions under pressure. This is a subconscious. The book covers 6 principles of influence. The one that matters most in crypto is social proof. When we're uncertain about what to do, we look to others to see what's correct. In the context of crypto, the most uncertain market in the world, your brain does what it's evolved to do. It looks at what other people are doing. You see the timelines, you see people posting the wins, and your brain concludes the herd knows something I don't. That conclusion feels like a signal. It's not. And oftentimes, the louder the herd, the more dangerous the entry. Hijack 2, the loss spiral. This is the biggest hijack on this list, and the most important one you need to understand, because it's actually 3 behaviors tied into one mechanism. When your chimp takes a loss, it does one of 3 things: panic sells, revenge trades, or refuses to admit when it's wrong. Let me introduce you to 2 psychologists to help unpack why. Meet Daniel Kahneman and Amos Tversky. These 2 guys spent decades trying to get to the bottom of why human beings act the way they do. Their work was so influential, in fact, that Kahneman won a Nobel Prize in economics despite not being an economist. That tells you just how seriously the financial world took what they had to show. One of their most influential publications was a piece called The Prospect Theory. The headline finding was something called loss aversion. The idea is that people feel losses a lot more than they feel the equivalent wins. Losing $100 hurts a lot more than making $100 feels good. And not a little more, significantly more. And the more advanced finding, also covered in the report, that most people decide to skip past is when people are faced with a certain loss, they become more risk seeking. When you're down, your brain will choose a worse expected outcome with a chance of recovery over guaranteed smaller loss. It's the same reason the gambler doubles down or the trader decides to place a revenge trade. Here are 3 examples. 1, you panic sell. Threat detected, eliminate threat. The threat is a position, so you eliminate the position. The fact that elimination locks in a loss is irrelevant to the chimp because the chimp doesn't think in months and years. It thinks in the moment. 3 weeks later, the asset is back above your exit. Why? Because it was not a thesis problem. 2, your revenge trade. The chimp interprets the loss as a personal attack. It's, I made a bad trade, I must be an idiot. I now need to prove to no one who's watching that I'm a good trader. Now, you go back in, you take a setup that's less thought through, and you're no longer investing in trading. You're trying to settle a score. The market doesn't know you exist. For the market, there's no score to settle, but it will happily take your money on the second loss as well. 3, you refuse to admit the loss exists. If you can't accept a loss, you can't learn from it. Whether it's a thesis breaking or a team change or a narrative shift, you're still holding. Why? Because you don't want to acknowledge you're wrong. Or you may not have been wrong. Maybe the information has changed. But you acknowledging that and cutting that position is you admitting, I got it wrong. I may be an idiot. That's something called the sunk cost fallacy in its purest form. Hijack 3, oversizing on conviction. This one's sneaky because it doesn't feel like a hijack. It seems rational. Let's say you have a position and you feel very confident in it. You've done your research, you've done your due diligence, you have a lot of conviction. It seems like a smart move, and perhaps it is. So you size up and up and up, and the next thing you know, this is 40, 50, even 60% of your position. Then a 30% correction and your portfolio is in the gutter. And now you start to realize what people are talking about when they mention the term risk management. Because here's the issue. Conviction is not the same as concentration. The chimp confuses them because the chimp wants to feel safe. And certainty feels safe. So it pushes towards more of the thing it's certain about. There's a book by Howard Marks called The Most Important Thing. Marks is one of the most respected investors in the last 50 years. Here's a concept that should govern every sizing decision you ever make. It's called second level thinking. First level thinking sounds like I'm confident in this investment, I should buy more of it. Second level thinking sounds like I love this investment, but does the market love it also? What has happened since my initial sizing that has made me believe I should be buying more? If the answer is I don't know, I just love it, then you shouldn't be sizing up. Loving a position does justify holding it, but it does not justify increasing exposure. Sizing up is only justified when the upside is genuinely underpriced relative to the downside. And the only way to know this is by using second level thinking. What positive catalyst did I not consider when I made my original thesis that made me decide my initial investment? Because if there is something, hey, then maybe I should size up. But if there's no additional reasoning, then why are you sizing up? You're just chasing comfort. But comfort kills. The chimp's confidence is a feeling, sizing is a calculation. Don't confuse them. Hijack 4, boredom forces moves. The market goes sideways for 6 months, nothing's moving, nothing's interesting. Your chimp does not like boredom. Boredom is for the chimp a kind of low-grade threat, so you start poking around. I hear people say all the time, if you're not moving forward, you're moving backwards. And I don't think there's another sentence in all of crypto that destroys more portfolios. In sideways markets, oftentimes not moving is the move. Stillness is not stagnation, it's preservation. The chimp can't accept it because the chimp interprets stillness as decay. And then it starts to manufacture action. And manufactured action loses money. Most portfolios in crypto don't get destroyed in bear markets, they get destroyed in chop. The disciplined operator is the type of guy who can sit on his hands for months without worrying about making a decision. Hijack 5, borrowed conviction. I've been on both sides of this hijack and I know it all too well. When I was 20 years old, I got into an asset called XRP based off someone else's call. The asset went crazy. We're talking 10x and life-changing money at 20 years old. When the market started to move against a position, I held even though I should have de-risked. Why? Because when I spoke to the friend who got me in, he had such confidence and such conviction that I didn't even ask for his reasoning. I associated smart guy with smart decision. I trusted when I should have doubted. My conviction was never mine, and when price moved against the thesis, my conviction had nowhere to stand. If you didn't do the work to enter a position, you don't have the right to hold it. Now, I'm the person on the other side of that conviction. People borrow conviction from me. So when I share a thesis, people tend to listen. And when I take a position, people copy it. That should make me feel good, right? It does not. It worries me massively because I know something that they're not considering. My position has a different shape to theirs. I have a different cost basis, a different size, a different entry. It maybe plays a different role in my portfolio. My time horizon may be different. I have a different exit plan. I might be in a position and it's 2% of my portfolio and 60% of theirs. There's a famous book called Skin in the Game by a guy called Nassim Taleb. And in the book, he makes the central argument is that credible advice only comes from people who have skin in the game, the people who pay the price for being wrong. And look, yes, I have skin in the game, but I don't have your skin in the game. If you copy my position, you lose. I don't lose. I don't pay that price. You do. Your downside is invisible to me. Your psychology is invisible to me. Your portfolio context is invisible to me. This is the corruption at the heart of all borrowed conviction. The person you're borrowing from is paying a different price than you are. The thesis must be yours, or it's not a thesis at all. Hijack 6, the identity hijack. This is a hijack that sits underneath all of the others. If you don't know who you are as an investor, the chimp will become whoever it needs to be in the moment to preserve itself. One week you're a Bitcoin maxi, the next week you're a meme coin degen. The strategy keeps changing because your identity keeps changing. And if you don't follow a strategy for long enough and you keep bouncing between them, things will never work. It's like going to the gym and trying to get in shape, but you keep switching up your workout program. It's not going to work. There's a book by a guy called James Clear called Atomic Habits. The central insight is that we don't change by setting goals. We change by shifting identities. Apply that to investing, and every trade you take, every position you make is a statement for who you are and what kind of investor you are. If your statements are scattered across 5 different identities, you have no identity. And without no identity, you have no strategy. A few years ago, I came across an asset called SPX 6900, and I got in early, the thesis was clean, and I did tremendously well. I made life-changing returns, and it was one of the best plays and trades I've ever made. The asymmetry was extreme. I sized the position perfectly. The entry was perfect, and I made life-changing money. But then I made one of the biggest mistakes of my investing career. I told myself I'd take profit and buy back lower. The problem was I'm not a trader, I'm an investor. But in that moment, I let myself become someone I was not. Why? Because of my ego. Allowed for certain hours and times. And to be honest with you, mostly for entertainment. There's nothing wrong with that. You need to opt for high quality sources. You don't control what you see on X, right? You have a following tab, but you are constantly shown stuff you didn't sign up for. Instead of opting for something like X, sign up to high quality newsletters on email. That way it's more in your control of what you're consuming. And be ruthless. Cut the nonsense. There's no second chances. Have a specific time dedicated to reading and decision making. This is where you sharpen your axe and program your computer. This is dedicated self-development. The computer doesn't get reprogrammed on impulse. It takes dedicated, high quality, undisturbed time. No price checking in bed. Sleep is absolutely critical. And checking a price right before bed is not conducive to high quality sleep. What's the best case scenario? You see a really good price, that's going to spike your cortisol. You're going to get excited. Bad sleep. Worst case scenario, you've seen the price tanks. More anxiety. Now you feel you may have to act. You're sad. You're negative. You can't do that. If I have poor sleep, I don't make decisions. I don't think there's anything more important out there than optimizing one's sleep. The ultimate takeaway here, and everyone has different things they do to optimize their environment, is remove things that require willpower and bring things in that give you energy and the ability to make better decisions. Most investors are trying to discipline themselves inside of a casino, but instead of trying to discipline yourself, leave the casino. Open your phone, delete one app you know is costing you money. You know which one it is. You thought about it as soon as I made the statement. The strategic operator. Let me tell you about all of the top investors I know. And these are not six-figure guys. These are 7- and 8-figure whales. They're not stoic monks. They're not emotionless robots. They feel the same emotions as me and you. The difference is they program their computers to make high-quality decisions, so their chimp has less decisions to make. There's nothing to hijack because everything's pre-installed. The most common system I see these people using, and I use myself, is having a strong stress testing procedure. This is the art of seeing every possible angle before you act. There's a book called 6 Thinking Hats by Edward de Bono, and I would say this is the easiest stress testing model to start applying to your day-to-day life. Before making any significant decision, you mentally put on a series of different hats and ask questions from each perspective. The bull hat. What's the best case scenario I'm looking to get from this? The bear hat. What's the worst thing that can happen? The risk hat. What can I actually afford to lose if things go wrong? The regret hat. If I do nothing, how will I feel? The process hat. Does this fit my rulebook or am I making an exception? The identity hat. Is this trade something the version of me I've defined as an investor would actually take? The calm hat. If I had seen this opportunity on a Tuesday afternoon at my desktop with some caffeine on standby, would I still be making it? The chimp only wears one of these hats at a time. The human can hold 2 or 3 perspectives simultaneously. The computer demands you go through every single one before making a decision. Accountability. There is another skill that separates the whales from the shrimp. That's called accountability. Remember the round trip mean position I shared at the start? Well, for weeks that position irked me. It pissed me off. I blamed other people. And I could not move on until I had internalized that loss and taken accountability. The day I'd accepted I had made the decision, no one forced me to hold, no one had stolen anything from me, that my own chimp had hijacked my emotions and rules, that was the day that failure became a lesson. Before accountability, you can't process a loss. You can only resent it. After accountability, you can actually extract the lesson and start to move on. I believe a lot of you are carrying baggage and resentment from losses, and the moment you take complete accountability, you'll have such a huge amount of weight off your shoulders and you'll get back in the game of making good decisions. That was honestly one of the best experiences in my crypto journey. The process allowed me to nurture my chimp and give my human the ability to walk back up to the plate with confidence. The funny part, my longer thesis remained. I was just wrong about timing. Now I can't lie to myself, it still was a loss. If I sold and bought back in lower, I could be 10x richer, but I didn't, and that's fine. And it's a loss. And we have to put a checkpoint on that, and now we move forward. I'm just satisfied that I did not give in to the hijacks after the fact. I didn't sell everything, I didn't take my ball home, I didn't cry about it, right? My thesis held, I held. The disciplined operator metabolizes losses quickly, cleanly, by owning them. And you should too. The cost of not fixing this. Picture it, it's 2031. The cycle you're in right now has come and gone. So has the one after it. The version of you watching this video never installed a computer. He never wrote the rules. He never audited his portfolio for emotional weight. He never defined his investor identity. He never changed the apps on his phone. And he never journaled his decisions. What does his life look like? What does his portfolio look like? He's still in crypto. The chimp wouldn't let him leave. He's still being hijacked. FOMO at the top, panic selling at the bottom, revenge trades, borrowed conviction. He'll tell you he's learning, he's repeating the same mistakes. He's still mentally calculating missed gains. He's still operating from scarcity over abundance. Every win feels like a near miss. Every loss feels like proof. He's still blaming the market, the macro, the influencer, anyone but himself. He had 2 or 3 moments in those 5 years where he could have walked away with life-changing money. He's poorer than he should be. He's more tired than he should be. He's angrier than he should be. And the worst part, he thinks the next cycle will be different. It won't. It's not about the cycle, it's about you. That version exists of you by default, but that's not who you want to become. That's the path you're on if you do nothing after this video closes. Don't do that. You are still in control. The principle. If you take nothing else from this masterclass, take this. The market is a mirror. It will show you exactly who you are. Your portfolio is not a record of your trades, it's a record of your decisions. The chart didn't make you panic, you panicked. The price didn't make you FOMO, you FOMO'd. The drawdown didn't make you capitulate, you capitulated. The market just presents conditions, but you are always the operator. And that's what's good about this. You are in control. You can win no matter the conditions. Your job isn't to predict the market. Your job is to become someone whose default behavior survives it. That's the entire game. The 5-step operating system. Everything I've taught you in today's masterclass converges into a 5-step operating system. Each one is something you can start tonight. Let's get into it. Step 1, the psychological audit. Before we can build any strategy, you have to know who's running it. This is the single most skipped step in all of investing. People copy strategies from people whose psychology is completely different to their own, and they wonder why they can't stick to the strategy. Do an honest assessment of yourself, your behavior, your patterns, your tendencies, your tolerance for drawdowns, your relationships with risks, your reactions under pressure, and critically, your identity. Are you a long-term holder? Are you a swing trader? Are you a meme coin degen? A macro investor? Pick one and pick honestly. There's no right answer. There are free personality tests online, the Big 5, the Myers-Briggs, risk tolerance questionnaires. Take a few, cross-reference, and get to know yourself. The point isn't to label, it's to surface the patterns that otherwise you pretend don't exist. There's no point claiming you can stomach meme coin volatility if you check your portfolio at 3 a.m. every single night. There's no point DCAing into Bitcoin if you want to make life-changing returns. Ultimately, you need to know who you are and build the strategy second. Step 2, define your North Star and set OKRs. OKR stands for Objective Key Result. And in my experience, whether it's business, investing, health, life, there's no better system for goal setting than the OKR system. The objective is your dream outcome, your destination. It's where you're trying to get. It's specific, it's visceral, it's something you can feel in your chest, and it's something you can picture, most importantly. The KR stands for key result. These are the measurables. These are the benchmarks to show you how you're getting on. The key results are the measurable benchmarks that tell you whether you're on or off track. Don't say, I want to get rich. That's just a feeling. Say, my objective is to build a multi-million-dollar liquid crypto portfolio by December 2028. And then you layer in the key results. By the end of year 1, I need to be at X. By the end of year 2, I need Y. I need to be contributing this much of my paycheck every single month to hit those targets. I need to hold this much cash buffer after every milestone, which can force me to de-risk. When you have a key result that says, I will be sitting on $200,000 cash, you have to take profit to hit it. So that removes the difficulty of not selling because you need that cash position. Step 3, build your rulebook. This is your computer made literal. Sit down on a calm day, no distractions, no positions creating emotional turmoil, and write your rulebook. This should contain things like, I will only allocate 15% to meme coins, not 16, not 18, not 20. I will only allow 15% of my portfolio in meme coins. I will DCA into Bitcoin on the 1st of every month, regardless of price. I will take 25% of every position at 2x's. I will not check prices between 10 p.m. and 8 a.m. I will not take a trade within 24 hours of a loss. If a position breaks its thesis, I will exit within 48 hours, no questions asked. Every rule is a decision your chimp can't hijack because you already made it. Step 4, find support. A community, a coach, a therapist. Humans are not built to make these huge decisions in isolation. We are wired for tribe. The chimp wants belonging more than it wants almost anything. If you don't get that belonging from a healthy source, you'll get it from Twitter at 2 a.m. or a Telegram group. Join a community, a real one. Last but not least, step 5. 5, journal every decision. This is the final lock that holds the entire system in place. Hindsight bias is one of the most expensive cognitive errors in all of investing. We grade decisions by our outcome. We fluke a 10x and we think we're a genius. We take an intelligent, asymmetric bet and one thing moves against us and suddenly we lose all of our confidence, we're an idiot. Both conclusions are wrong. Write everything down the moment you make your decision. That way you're not clouded by hindsight. What's the thesis? Why am I taking this position? Why am I sizing the way I'm sizing? Then come back later and grade the decision, not the outcome. Sometimes good decisions lose money and bad decisions make it. The journal is there to go back and look at and say, well, regardless of outcome, was I making a wise decision? And when you document this over years, you can start to make better decisions time and time again. This is a type of checkpoint system. Grade against the plan you had rather than the perfect outcome. Because ultimately, the version of you at the top didn't know it was the top, and the version of you at the bottom didn't know it was the bottom. The medium of your journaling doesn't matter. Written journal, trading journal, video journal, on your phone, voice notes, whatever you'll actually do and stay committed to, that's what you should do. 5 years of journaled decisions is one of the most valuable financial assets a person can own. That's it. 5 steps. 1, know yourself. 2, define your North Star and set OKRs. 3, build your rule book. 4, find support. And 5, journal every decision. That's the entire system. Every chimp problem, all 6 hijacks that we covered in this masterclass, now is diagnosed and has an answer in those 5 steps. The work isn't glamorous. It's the unsexy infrastructure of becoming someone whose default behavior survives the market. But over time, that infrastructure compounds. Every month you operate this way, you become a slightly better operator. 5 years in, and you're a completely different investor. I want to leave you with one thing. The chimp inside you is not going away. Not after this video, not in a year, not in 5 years. The chimp is permanent. What changes is the computer you program around him. That's the game. That's all of it. I'll see you in the next one.